What's up, people? Welcome or welcome back to Invest with T-Claus. My name is Tevi, and this is a channel dedicated to my investment journey, along with coverage on Tesla, NIO, Virgin Galactic, and ChargePoint. Come for the information, stay for the random clips. All right, so let's kick off today's video with a big shout out to Mark and Cindy for joining the Tesla family. And as a result of their use of my referral code, which you can find in the description below, they gained 1,000 miles each of free supercharging from Tesla. And so did I, right? So I was expecting Mark to join the Tesla family, but Cindy was a total surprise. And this is pretty much how I felt when I saw the free 1,000 miles of supercharging from her using my referral code. It certainly was a nice surprise, totally unexpected, and that's what makes it that much better. Anyways, thank you again for using the referral link. Enjoy the new cars and the free reward that came with it. All right, so as a reminder, next week will be our Q1 2021 earning call, at which point I'll go through my portfolio, how I've done so far this year. And because I don't expect us to necessarily make up the 55 subscriber gap between now and then, which is all right, we'll just focus on the top 4 cornerstone stocks and how those have done in relation to the rest of the portfolio. All right, so now that we're done with the announcements, let's get into what the focus of today's video is going to be. Let's face it, if you're invested in some of the same names that this channel covers, you're more than likely, especially if you came in around January, February timeframe, more than likely upside down on your position. So rather than going through how each stock is doing individually or cover some of the news, I figured it would be more important and beneficial to get a glimpse into the mindset of how money managers are actually thinking. So the focus of today's video is going to be on reviewing maybe a couple of the interviews that took place earlier this week, and then I'll add some commentary for context where I see fit. And then we'll wrap up the video with what I'll be looking for as we wrap up the quarter and head into next week. All right, let's get into the video. I've touched on this a bit before in previous videos, but 2020 was not your typical year when it comes to investing. It was, however, a great time for new investors to get into the market. And the reason for this is because the Standard Playbook for Wall Street just didn't apply, right? And when I say Standard Playbook, just overly generalizing. But the point here is, the reason why the Standard Playbook did not work or did not apply is because everyone pretty much wrote off 2020 and was focused on what 2021 would bring. And so for that reason, there was a lot of concentration into tech stocks, and any stock that posted an upside surprise and or was again in growth or the tech sector saw a lot of money flow into it. So if you think about Nvidia, NIO, Tesla, Zoom, a lot of those names moved up in a major way last year. Think anywhere between double your investment to 10 times. Well, that was mostly because it was all about concentration in tech and growth. That's really all that was working, rather than diversification and sector rotation. So let's be crystal clear here. Those days are over. Why? Because the economy is reopening. And as a result, money managers now have a lot more options for where they can place their money and put it to work. So in my opinion, for you to be successful, again, I'm not a financial advisor, but I think it's important to understand the mindset of money managers who are in charge of large amount of capital that have sway over the market. And so for this reason, I selected a couple of clips that were aired earlier this week, where a bunch of money managers and financial advisors are talking about the market conditions and what they're looking for. So let's take a listen. I'll add some commentaries where I see fit.
We're still going to be grappling with this question about economic growth and how that impacts interest rates and inflation, especially because many investors today have never invested through an inflationary environment or an environment where interest rates were rising. So I think it's going to create volatility, but that in turn creates opportunity. So to your point, Scott, I think it means you have to be a little bit more tactical. So selling your winners when they've moved up significantly, maybe taking advantage of some of the opportunities in the market as they present themselves. And I think we will likely see this continued shift, although I think ultimately cyclicals are going to perform better than the growth stocks. But I think to the extent that we do get a growth scare, whether it's COVID related or related to interest rates rising too quickly or inflation that looks like it might be here to stay, I think there will be a rotation back to the growth side. So I think it's important to have exposure to both. But here and now, I think the opportunity really is presenting itself more in the growth side than on the cyclical side.
She makes some really solid points here, and in case you missed it, I want you to go back and take a look at some of the names that were in that side window next to her. those represents the long-term investments that her portfolio is managing. And this is important to understand. Fund managers have both long and short positions that they ultimately manage. The rotation is performed on a quarterly basis, sometimes more often. Think Kathy Wood, who basically almost trades daily. But the point here of the rotation is to ensure that they're winning no matter what's going on all around for their clients. What's important to understand is that unlike you and I, they have millions, sometimes billions of dollars that they can play with, right? And so with that much capital available and invested, it makes sense. The concept of broad market diversification makes perfect sense. And so you can be in 30 to 40 companies across multiple sectors and have very strong positions in each one. When you hear her talk about multi-sector exposure, selling your winners and taking some profit and shifting some of that, it doesn't mean that she's fully exiting any of those positions. What it actually means, and this is again important to understand, is that they're taking those massive gains that they made on one sector and transferring those funds into what they now expect to be hot over the next 3 months, maybe sometimes the next week, next 3 months, or 6 months, and positioning themselves so that they have a strong position in some of those names that they expect to pop over the next few weeks to months. One of the 7 principles that I follow as part of my investment thesis is that I must know what I own. Again, this is not to be taken as financial advice, but I think it's pretty important and key to know what you're invested in, and not just that, understand what's the time horizon for the company that you're following and putting money into for them to accomplish their goals and their vision, right? And so why that matters is that when it comes time for the market to inevitably rotate away from what you like, because it happens all the time, not that we're back in this environment, at some point or another, the market will rotate away from what you like. And in my case, it's growth, it's tech. Others, it might be banks, financials, and things like that. It doesn't really matter. The point is, there's always that constant rotation. And so when that happens, the only way that you can recognize opportunity and take advantage of it is if you understand that fundamentally nothing has changed with your stock, and that it's truly just a market rotating away from it, which then presents a massive buying opportunity that if you have cash available, you can take advantage of. And if you don't, then you just hold and just let it play out.
Doc, you're the one more than anybody else, I think, of late who's been a little more concerned about where rates are going and what the reaction in the market was going to be as a result. That if rates continued to tick up, you thought we could have a substantial correction in the market. Do you still feel that way?
I still feel that way, Scott, but now I'm not as worried about that scenario playing out. And here's why. Number one, you've got a ship, a big cargo ship, sideways in the Suez Canal so nobody can pass. That means a lot of goods that go into Europe as well as out of Europe aren't making that trip right now, Scott. That's 10% of global trade. Number two, the problems they're having with the vaccine and even Angela Merkel doing that 180 on the lockdowns that she had proposed over Easter. I think those are things that have put a lid on growth over there in Europe. One, a natural disaster of sorts, that ship, and the other, the fact that they haven't got their act together yet on vaccines. So I think that the growth, if we were both growing at the same time, Scott, the two of the 3 largest economies on earth, the United States and Europe, if we were just booming, then yeah, I'd be more worried about that 185 on the 10-year, 195 and 2 before June. Now, I think that is mitigated by those things I just described. So I am not as worried about that now. I think this is sort of like when you hear talk about taxes increasing, that's another way you hold inflation back. I think this has done that for the Fed, and sooner or later they'll address that either in testimony or just in straight out speeches that the Fed speaks will be making.
Okay.
Some interesting commentary here by John, and some of you may have already caught on to this, and if you did, leave it in the comments below if you know exactly what I'm about to say. But did you notice that his entire talk track around inflation fears and concerns of it arriving was centered around the inflation arriving before the end of June, which is essentially the end of Q2. And so why does that matter? Well, because from a macro perspective, this would mean that it would put a damper on realizing gains, right? And so let me explain it maybe a little bit more simply. If I was playing the rotation game and I was investing into reopening plays, so let's say that, Delta, for example, was one of the plays that I was interested in getting into, well, I wouldn't wait until June or summer to start buying stocks in Delta. I would have started buying the second President Biden came on TV and announced that by end of May, we would have enough vaccines for the entire US population. This would ensure that I benefit from the full run-up in the stock price all the way to earning results at the end of Q2. That would inevitably encompass all the revenue and sales from the booked vacations. Also, did you notice that in that little side window, NEO, Tesla, Virgin Galactic were part of his long-term positions? I certainly did. And so, no matter how you look at it, short-term reopening plays are going to dominate. They're going to do much, much better. But what I'm really keying off of here is that John, along with many other money managers, are not so much concerned about inflation being a real thing. They're all coming around to the side of it's going to be transitory, which is basically what the Feds and Jay Powell have been saying for the longest time. And so really what that means is that, again, near term, yeah, it's going to be bumpy and, we're going to see some ups and downs. So when I'm hearing these conversations, what I'm really looking for here is what is the time frame context, right? Are they talking about the near term, so like the next week, 2 weeks to a few months, or is it truly changing the narrative around a long-term outlook on a specific stock or the market in general? Because there's a difference between what they're doing, which is minimizing short-term, near-term risk so that they can keep making money, versus what I'm interested in, which is long-term. Do you see the stocks that I'm invested in not performing? And if so, why? And do I need to adjust my investment thesis as a result?
So all-time highs today out of the cyclical space: General Motors, Whirlpool, Caterpillar, Deere, Dover, Honeywell, Jacobs Engineering. Is it time to look at these gains and do what Ricky Sandler's doing and look to take some profits and some chips off the table, or not?
I believe that you definitely have to start looking at it. You look at Caterpillar, which is selling at 20 times forward earnings. That's if they get there. And I think that's expensive. Look, if Powell's right, we have transitory inflation, then that's not going to be good for Caterpillar. So you got to be taking some profits on the cyclical stocks. So I'm watching inflation. I'm watching, the general economic news, more important than they've ever been. But I believe the market can ultimately withstand a 3% as long as we don't get there next week, get to 2.5% next week. I'm looking for 2% over the next month or two. I think we'll be fine because the market doesn't believe Powell has the same credibility that he had. The Fed put is gone. You need to see a major move in rates to have a twist, which means for them to buy long-dated, sell short-dated treasuries. So that's what you got to watch.
So once again, you hear it, short-term view, week-to-week trades, and how to position themselves now that we know that the Fed is not going to be stepping in, right? So I think it's pretty clear, and they've all accepted it, that unless real inflation is here, Fed is not going to step in. So what that means is that they're all left to fend for themselves, and they have to be extremely strategic about how they're playing this rotation game and what sector they go into and exit, right, in the near term, week to week. So if you think about it, really, when we talk about market corrections and they're all concerned about that, all at a most basic level, all a market correction is everyone who's over here in this sector is transitioning either completely or significantly enough that as the money shifts from here to this side, all the stocks are dropping, right? So at that point, if you didn't follow the crowd and you're still over on the other side, you're faced with the decision of either holding or taking a major loss to exit your positions. And if we bring it back to what that means for you and I, well, you have to decide if you're going to be trying to time the market and follow the big funds, or are you going to hold your ground and use that shift as a buying opportunity for yourself and to advance your positions?
All right, Anastasia, I mean, it seems the biggest question in the market right now is whether we're going to have a big correction in the market or not. So when you look at where we are, what do you see?
Yeah, I think, Scott, that has been the question sort of since the beginning of the year. We're going to have a big correction, and the answer we had a mini correction. But what I'm encouraged by is that when we look at the positioning of some of the hedge funds and some of the levered funds and CTAs, they have actually been reduced. So I think we had a clearing out of the squaring of positions in February and early March. So that's a constructive setup there. What I'm watching, like Steve, as we go into Q2, is this momentum handoff between we believe growth is going to happen in Q2. We believe reopening is going to happen in Q2. But do we believe inflation is actually going to come, and could that potentially surprise to the upside? So I think that's going to be a key conversation for the markets in Q2. We're likely going to see some core PCE prints that are going to surprise to the upside, perhaps. And then on top of that, all this fiscal stimulus, the infrastructure package talk is going to heat up in Q2. So all of a sudden, I think what the momentum conversation is going to become is not so much about the reopening trade, but the reflation trade and how to position for that.
So there you have it. Her last comment there, in my opinion, sums it up quite well and is a clear sign that the Wall Street playbook is back in full effect, right? So I know that this is overly simplifying things, but one of the 7 principles, again, that I follow is to keep it simple. There's all this information out there that I need to be able to digest and boil down to simple takeaways that I will make actionable. And we'll get into a little bit more detail specifically of what that means for the portfolio next week when we go over the performance for the first quarter. But right now, here are some of the takeaways that I have, and I'll use my notes here so that we can walk through them quickly. So number 1, retail investors are no longer in charge of the market, right? So the 2020 YOLO-style investing method is probably not going to be as effective or just simply not work. I would also say stop speculating on random investments and following the crowd if you don't understand what's going on. Number 2, you got to have clarity on your investment thesis. And so just because the market is rotating away, there is no reason for me to start buying all of a sudden industrials and banks and financials. I don't like those. There's no point in me doing that. And despite all this talk of rotation, the pros are still invested in the same names as I am, right? And really, why would that be? Well, because winners are going to be winners. It's all about the time horizons. Number 3, portfolio diversification and multi-sector exposure. Don't start diversifying and buying a bunch of other things just because people on TV tell you to, right? It only makes sense if you, again, understand what those plays are and that you, again, can allocate the right amount of your portfolio percentage to that to generate a return. If you don't understand it, don't buy into it. Simple. Number 4, don't buy into momentum. The market might rotate back into growth and tech, and this is not the time for you to start buying as everything is going up. Again, all they have to do is rotate away, and if this is not something that you're looking at long term, you're going to lose money. So instead, buy on those red days. If you're going to start establishing a position, red days are when you would go in and start buying, again, little by little and averaging your way down into a position. Number 5, only invest money that you're comfortable locking up for a reasonable amount of time, right? This should not be money that you need for next week, next month, or to pay rent or whatever else. This truly needs to be extra money that you have and that you're comfortable seeing it go to 0. So again, this might sound pretty extreme, but that's the mindset that you need to be in if you want to be able to hold these positions through the extreme volatility that it's likely going to experience, especially if you're in the same names as I am. All right, so getting towards the end of the video here, and again, we're not going to go through the weekly performance review because next week will be all about performance and how the portfolio has done. The last bit of information that I want to touch on and what I will be focused on as we head into next week is going to be the address from President Biden as he unveils his new infrastructure and clean energy bill. And the reason that is because, well, I'm invested in Tesla, NIO, ChargePoint, which would all benefit from whatever might come out of that bill. So it is off of great interest to me. So I'll be paying attention, and if there's anything notable in there that you need to know, I'll probably bring it back and share it, some highlights from that on the channel. So I know that today's content was a bit different, but the whole point of this channel is to cover my investment journey and my thought process and how I arrive at my conclusions and what drives my decisions, right? So again, not a financial advisor, but I figure that if you understand my thought process, you can also make better decisions in your own investments and decide if what I'm saying makes sense for you to either apply or at least use that as a point of as an input in your own investment decisions. All right, people, this will do it for today's video. As always, if you enjoyed the content and found it insightful, please drop me a like and share with your friends. For my newcomers, remember to hit that subscribe button and ring the notification bell so that you are notified when new content drops every Sunday and occasionally during the week. As always, thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.